good understanding about the advantages and disadvantages associated with going to a lower entry or moving to a higher entry time frame. And hopefully you also understand now, because it's very important to understand this, that there's a lot of work associated with actually making money on the lower time frames. But the reward, of course, is very heavily there and existent, right? Now, before we continue on with overall understanding of concepts and tools, I want to give you the generality of EVC and what you're actually doing. What are some of the concepts and tools that we're using? So you can write these down, you can keep them in mind, so that when we come to covering them, you start understanding how everything plays together. So the generality of EVC is starting with the E, okay? That's the entry time frame, as you all know. So let me actually draw the thing again. So E, V, and C, right? E, V, C. This is the overall system that you generally use for your given timeframes, which are all fractal, which means they repeat themselves no matter what timeframes you're actually using. So the entry time frame is where we follow the actual orders, right? How is that selling and buying happening? Where's the accumulation? Where's the distribution? What's actually going on there? And we'll learn all about that in a second. To get involved, right? We actually use those moments to get involved. And some of the main tools that we use are stages, our moving averages, our MBs, as you've already seen, and models, right? And as you know, if we go back, close to every entry that is actually taken by me is some kind of buy stop of an MB, or a mini MB, or an MB, or a sideways MB, or whatever it might be. And we'll talk about sideways MBs for entries and whatnot in a second, but every entry is based on the creation of an MB, because we start understanding that, we have the formula of demand, right? Once we understand the formula of demand, we know how that's actually creating demand. And as a result, we know that that is multi-timeframe MBs, so we use them to enter. Okay, so for the entry time frame, these are the main things you're using. And one of the things we're going to start with understanding is actually stages and models. These are things that kind of interact together. And we'll talk about that in a second. But here's a quick little demonstration, right? Where, again, you have some kind of anticipation of the low rule being met. So that's overall potential accumulation happening. And then you have MB-based setups, ones that you can enter lower, some that you can enter in a larger way, some you can enter up here, new ones that happen, entries, so on and so forth, until you get positioned and hopefully you're part of that trend. That's the entry time frame. We view the actual orders of the lowest time frame we're willing to trade on, and we see how they interact with the V and the C, which we'll learn about in a second, and we get positioned. That's the generality start of E. For V, this is actually the majority of where our work takes place, and it's basically the consideration for any given market. It gives us the reason to look at the entry of any given market, right? So the V is the ultimate controller of whether it even makes sense to start looking for trades, or if the entry time frame is worth being looked at. And you're going to learn about this in a second, but the main things that we use on these are stages, prior stages, right? What were some of the prior stages doing? Moving averages, again, so you should be seeing a little bit of a dynamic here, because these things are going to become very important in a second. And relativity in terms of other markets, in terms of what it's doing with similar markets, similar areas, similar companies that deal with doing the same things. Because oftentimes, if a company that buys bananas is doing very, very well, other companies that buy bananas or do banana-related things are going to do very, very well. And if one is doing better than another, or showing that it's doing much better than another, then you know that market itself, based on the actual price action itself, is now a lot stronger, and as a result could be much better for making a new move, a trending move, because new investors, comp set operators, whatever you want to call them, will come in a huge way. And then you have the C, which is the context time frame. And this is where we basically, on a higher time frame, we want to ensure that there is proof that price can still continue to make a move. Okay, and some of the concepts that we actually apply to this is not dramatical extension and our position in regards to the moving average. I actually think I had another one. So hopefully, I lost it. So basically, we want to see that it's not dramatically extended, which oftentimes comes back to stages and where we are stage-wise, and the position in regard to moving averages. And I'll talk about why and how in a second. But this is generally your everything put together. This is what an overall system will look like. And what I call it So here you have the EVC again. What this entirely entails, if we put a box around it, this creates what we call either, well, it's called two things, but I'm going to make this very easy. It's called the context of the market, which, it's telling you what the story behind the market is, basically, okay? Now, because a lot of you should be seeing the fact that we have an entry time frame, validation time frame, and a context time frame, these might confuse you because they're the same thing. So what I'm going to do instead is I'm going to start calling EVC a story. Okay, so what's really happening and what price is doing is the EVC, the interaction of multiple timeframes, which are simply a study of the orders that are coming into the market, the buying and selling, the creation of MBs, the creation of accumulations, which we're going to go over in a second. Those interacting amongst timeframes with their given tools, like moving averages, like stages, like models, like relativity, and other things, these all create a story around the market that we're actually watching or the asset that we're looking to trade. And that story either continues to play out and is worth following and reading. So think about, like a really good book you read, you picked up, or a movie that you've seen. The story progresses and the story makes sense and the story is good. Even if it throws a few crazy little, what do you call them? When you're surprised over seeing something, because you weren't expecting it. I forgot what it's called. But, if that happens in a movie, but the movie's good, you'll keep watching because the story is interesting to you. And other times, you probably picked up a book or a movie and you're like, this is terrible. This makes no sense, right? There's no reason for me to watch this. This is not art. This is not a good movie. That's really how assets function. The only difference is that assets can go through story changes over and over and over again, because at some point a story with an EVC might be super, super clear and it makes sense to keep watching it. The movie is great. It makes a lot of sense. And the story can then become bad. So all of a sudden you step away from it. But this is the generality of EVC, where we look for a synchronization, a dynamic between the three timeframes or more working together to create an overall story of that market. And if the story is good, is clear, and makes sense, then we are willing to put up our risk behind the thing that's happening. So that's the main purpose of EVC. It's understanding that you're not just sitting there looking at one time frame to prefer an entry based on a pattern, because that's not what formulates moves. If you're the kind of person that thinks you can go ahead to any market, here's US 100 for instance, go to a time frame of your entry and go, okay, we're making an MB, I should probably buy here, right? The reality is this is going to work well in good markets, in good stories, and it's going to work terribly in bad stories. And the reality right now is that NAS, for the bullish side at least, isn't a terrible, terrible story of what's happening, which means that anyone taking entries like this, which is a lot of the traders that you probably worked with, the mentors you've seen online and all this stuff, are going to take huge losses over and over and over again, because there's no understanding behind story. There's just an understanding behind, let's say, a pattern or the potential of a pattern. So this is, again, one of the moments that I want to undo the thought process in your mind that you're here to trade a pattern or there's a simple pattern you can learn to make money, because that has never been the trading space. And if you think that, you're going to end up losing. So instead, we want to change our mind to synchronization and to story. We want to understand that timeframes interact with each other, and when they start lining up in a way that makes sense, that's when we put our risk behind it. And as a result, this is the general application of EVC that we want to use in our trading. We want to see these all kind of align in a clear way before we look to actually enter a given market or enter a given market for the MBs that are forming, whatever it might be, because a story is necessary. And if a story is not there, then we are being idiots randomly entering things, right? And the reality is most people lose because what they do is they study patterns, they apply those patterns, and they sometimes win, and they mostly fail. And that repeats over and over and over again because they think a pattern is going to make them profitable, when in reality, it's an understanding behind how markets operate or what the composite operator wants to do that actually creates moves in the market that become worth putting your risk behind. So this is the starting points of true EVC. And now, in the next one, we're going to jump into the start of accumulation. So I'll see you then.